Most Americans think real estate makes you rich because prices go up. That belief sounds simple. It feels safe. Buy a house. Wait. Sell higher. That story comforts people. It also keeps most people average. Because the real engine is not appreciation. The real engine is structure. And structure is invisible at first. You do not get rich by owning property. You get rich by understanding how property interacts with debt. That is the part nobody explains clearly. In the United States, money is created through lending. When banks issue loans, new dollars enter the system. Debt is not just an obligation. It is participation in currency creation. That changes how you see leverage. Most people use debt to consume. Credit cards, car loans, lifestyle upgrades. That type of debt drains. It does not produce. But there is another category. Productive debt. Debt attached to an income-producing asset. That is where the shift begins. Residential real estate sits at the center of this structure. It has two engines working together: demand-driven value growth and income-supported leverage. Population grows. Jobs cluster in certain cities. Economic activity concentrates. Housing demand follows that gravity. Over time, demand supports prices. That is the first engine. But appreciation alone is slow and unpredictable. The second engine is more powerful. Leverage. You do not need full capital to control a property. You need structured capital. A down payment unlocks full asset control. If value rises, it rises on the entire property, not just your cash. That is the multiplier effect. But here is where it becomes interesting. Most people stop at one property. They let equity sit idle. Equity feels good on paper. It feels like progress. But paper equity is frozen capital. And frozen capital does not expand. There is a model that changes this. It is not about buying and waiting. It is about activating value. First step. Acquire below potential value. Not perfect property. Under-optimized property. Something with room to improve. Then apply targeted improvements. Not cosmetic fantasy. Strategic value enhancement. Renovations that increase market perception. Improvements that justify higher rent. This is value activation. You are not gambling on the market. You are manufacturing equity. Once the property stabilizes with rent, something shifts. It becomes income supported. Cash flow secures the structure. Lenders see stability. The property is re-evaluated. If value has increased, New equity appears, but it is unrealized, still locked inside the asset. This is where most people stop. They celebrate the higher value. They feel wealthier, but nothing changes in their liquidity. The system changes when you refinance, based on the updated value. Lenders allow a controlled percentage of debt, often 70 to 80%. That loan replaces the old one, and the difference comes to you as capital. You did not sell. You did not exit. You extracted equity. Unrealized gain becomes liquid investment capital. That is the pivot. The property still produces income. It still appreciates. But now it has also funded your next acquisition. This is capital recycling. Initial capital buys property. Property creates equity. Equity becomes new capital. New capital buys another property. The cycle repeats. Now imagine this over multiple properties. Each stabilized asset becomes a small equity engine. Each engine feeds the next. Growth does not depend on salary anymore. It depends on internal equity regeneration. That is a different game. This model is often described as buy, improve, rent, refinance, repeat. But those words hide the architecture. The architecture is equity to liquidity conversion. You convert static value into mobile capital. You do it without liquidating the asset. And you stay within controlled debt ratios. This is not reckless leverage. It is structured leverage. There is a difference. The United States financial system supports asset-backed borrowing. Interest on investment debt often receives tax advantages. Expenses related to income properties reduce taxable income. The system is aligned with productive debt, not consumer debt. When you understand this alignment, something clicks. Wealth building is not about avoiding debt. It is about aligning with the type of debt the system rewards. But scale matters. With each property, equity creation potential increases. More assets generate more appreciation exposure. More rental income stabilizes more debt. As the portfolio grows, refinance capacity grows. Expansion accelerates. Not linearly. Exponentially. That sounds powerful. It is. But only if controlled. Because leverage cuts both ways. If debt ratios climb too high, sensitivity increases. Interest rates rise. Payments adjust. Market values decline. Equity shrinks. Rental demand softens. Cash flow tightens. The structure depends on balance. This is not about chasing maximum borrowing. It is about sustainable multiplication. Location matters deeply. Demand-driven areas support long-term value. Employment growth supports rent stability. Economic strength reduces vacancy risk. Cheap property in weak areas looks tempting, but structural demand is the foundation. Without it, the engines stall. Credit profile matters too. Interest rate is capital cost. Lower cost amplifies long-term returns. Higher cost compresses margins. Small percentage differences compound over years. That is why credit discipline is strategic. Now step back. What is really happening here? You are using the banking system to amplify asset control. You are using appreciation on full value while investing partial capital. You are recycling equity instead of letting it sleep. You are aligning with tax structure incentives. And you are repeating within risk boundaries. This is not speculation. It is structural participation. But there is psychology involved. Most people fear debt. They associate it with stress. They have seen consumer debt destroy families. That fear is understandable. But productive debt behaves differently. It is attached to income. It is backed by an asset. It can be refinanced. It can be structured. The mindset shift is subtle. Debt is not the enemy. Unproductive debt is. Another psychological trap is impatience. Real estate wealth is cumulative. It builds through cycles. It requires discipline during slow periods. The first property feels heavy. The second feels possible. By the fourth or fifth, the pattern becomes visible. Compounding begins to show its shape. This is not overnight wealth. It is engineered momentum. Time becomes an ally. Because appreciation applies to the full asset value. And equity accumulates quietly. Each refinance unlocks dormant capacity. Each acquisition increases exposure to growth. The system feeds itself. But do not ignore the risks. Over-reliance on rising valuations is dangerous. Market downturns compress equity. High leverage magnifies vulnerability. Interest rate volatility changes payment structures. Operating costs increase over time. Taxes and insurance can rise. Cash flow must remain resilient. This is why stabilization before refinancing matters. Rent must cover debt and expenses. Margin must exist. Expansion without cushion invites fragility. The model rewards precision, not aggression. There is also an alternative path. Real estate investment trusts. They offer exposure without direct management. Capital light. Liquid. Diversified. But they remove control. They do not allow equity extraction cycles. They do not allow forced value activation. They are passive participation. Direct ownership is structural control. Different tools. Different outcomes. Now imagine 10 years forward. Instead of one property, you control several. Each one partly financed. Each one generating income. Equity accumulated across the portfolio. Debt amortizing slowly. Values potentially rising with structural demand. You have options. Sell selectively. Refinance strategically. Hold for income. Or restructure. Flexibility increases with scale. That is the hidden advantage. Control creates optionality. Optionality creates security. Security creates freedom. And freedom rarely comes from salary alone. Here is the deeper insight. The asset itself is not magic. The structure around it is. Acquisition below potential. Targeted improvement. Rental stabilization. Reevaluation. Refinance within ratio limits. Equity extraction. Reinvestment. Risk monitoring. Repeat. That is the architecture. If ignored, you stay dependent on external income. If misunderstood, you over-leverage. If executed precisely, you compound. This is not about being a landlord. It is about building a capital machine. A machine powered by equity recycling. Supported by demand. Amplified by leverage. Balanced by discipline. Most people chase appreciation. Few engineer equity. That is the difference. And once you see it, you cannot unsee it. Real estate is not just property. It is a system. A system that converts value into velocity. Velocity into scale. Scale into wealth. But only for those who respect its mechanics. If this perspective shifted something in you, pause and think. Look at your current capital differently. Look at debt differently. Look at structure differently. Because the opportunity was never hidden. It was structural. And structure rewards understanding. If you want to keep exploring,